and as a martial arts instructor. And then they decided, well, can we get round pay-as-you-earn by reclassifying the individual as a partner? And partners don't need to have national insurance and pay-as-you-earn applied. They just take partnership drawings. That was a pretty good plan, except for it overlooked two elements. Number one, there was no paperwork about him being a partner. He never saw any partnership accounts. There were no partnership meetings to which he was invited, and he signed no partnership agreements. And then there was the fact he still continued to receive sickness and holiday pay and was not liable for business losses. And he also worked under the control of his former employer and therefore was not considered as self-employed because he was under the strict control of his former employer. Therefore, on that basis, the tribunal had no problem in deciding that there wasn't a partnership in either substance or on paper, and therefore the individual was still subject to pay-as-you-earn and NIC. Other element would be, again, back down to the public sector, somewhere like the BBC, British Broadcasting Corporation, where they have about 100 freelancers where their status is under question. Now, the interesting point about that is quite often the engaging company thinks about making some form of disclosure on this to help settle the case. In this case, neither HMRC nor the contractors concerned were very keen on a disclosure, and they said, you don't need to do anything, we will settle it directly with HMRC. One point is that even if this case is settled in favour of the taxpayers, these presenters and freelancers will undoubtedly be caught by the new PSC and public sector rules coming into place next month. Other elements, if you have large companies and they get involved in transfer pricing disputes or any other form of dispute where two countries are basically claiming the same amount of tax should be taxed in their country. So maybe the UK's done a transfer pricing adjustment and thinks 60% of the income should be taxed in their country. And Italy's also done a transfer pricing survey and thinks that 60% should be taxed in their country. Clearly, it would be unfair if 120% of your income was taxed between the two countries. If there is no agreement, it should go towards a mutually agreed procedure, and there is a minimum standard, and the UK is adopting this minimum standard, which is supposed to facilitate the earlier settlement of cases. Remember that in international disputes, you may have a dispute with a particular country, you may have a dispute with two countries, but if these are unresolved, then eventually it goes to a mutually agreed procedure, which is not between the company and the revenue authorities, but between the two revenue authorities at who should recognise the income and where the expenses should be recognised. Element here that I wanted to talk about is the element of penalties, particularly for those who are involved in the construction industry scheme or other elements. What you have is a situation where, quite kindly, the HMRC had mitigated the penalty by 85%, which is the normal standard element on which, the first line of a penalty, when they're looking for penalties, the normal floor they're now looking for is 15%, going up to 100%, and indeed more than 100% if an overseas jurisdiction is involved. However, what the taxpayer did was there was a 15% penalty, reducing it to 9,254. And the penalty was reduced, and what you can see is that actually it wasn't a very large amount of money in terms of tax, but because the delay had been nearly 5 years, the tax-geared amount and the additional daily and other penalties added up to a very substantial figure, to the point at which the penalty can massively overshadow the amount of tax due. You still need to show cooperation with the HMRC in trying to resolve tax disputes on a timely basis, give the right information on a timely basis. And if you don't do so, then there is always a strong possibility that the tribunal, the HMRC, will impose a higher penalty, and the tribunal will not be sympathetic in reducing that penalty if you've not shown the correct amount of cooperation. And in this case, unsurprisingly, where you've had a delay of nearly 5 years, the application to reduce the penalty was refused. Here we have an issue about records. So, when you have a taxpayer's records, particularly in an unincorporated business, you've got the issue about what element can the revenue see and what element can they not see. So if you get what is called a Schedule 36 TMA 1970 request for information for business records, you need to work out what's your business expenditure, what is your business records, and what are private records. And the elements on due diligence and transportation documents were that the First Tier Tax Tribunal said that these were definitely business records, since they were not kept for private or personal use of directors or companies. So therefore, what you need to do is, when you get a request from HMRC for business records, to carefully delineate what they're entitled to see and what they're not. And of course, if a client has been mixing up too much their business and personal records, you may have an issue keeping their personal records outside the scope of the investigation. Houses to be occupied in connection with a business. So a bungalow was subject to an occupation restriction limiting use to persons employed in the fishing business operating from the site. It could not be a dwelling for the purposes of the VAT DIY scheme. But it also could have effect in terms of a PPR claim, a claim for principal private residence relief. One of the elements that people need to be aware of is, in the increasing use of home working, it's quite useful to get a business tax deduction for a proportion of your property. But if you specifically delineate a part of your property which is 100% used for business, one element would be potentially looking at business rates, but the second element could be the restriction in principal private residence relief. So normally speaking, what you get is a particular part of the property which is used maybe 90% for business, but still should have a personal use in order to look at maintaining the very valuable principal private residence relief on the gains on a UK residential property. Here we've got new guidance on a change to the law which came in last year, but is of some interest in terms of profits from trading in or developing UK land. So, the rules were introduced in Finance Act 2016, and of course they are not particularly straightforward. They're in the Business Income Manual, which is one of HMRC's manuals, and there's 64 pages of explanation and definition. And the rules extend the scope of UK taxation to profits from a trade of dealing in or developing UK land, regardless of the residence of the company or individual making the disposal. If you have investment income and profits charged elsewhere to UK tax, they would be excluded. So one of the elements that you're going to look at, for example, is if I have a team of people in the UK, but it's not a permanent establishment. Previously, if there was a possibility I would get away without paying UK tax if there was no permanent establishment in terms of developing the property, particularly if it was done for a period of less than 12 months. Now what they are looking to do is to ascribe a permanent establishment status either to the team working in the UK or potentially to a part of a business, even if the main part of the business is residents outside the UK. And then again, what they're looking to do is to ascribe the motivation for having the property. So was it an investment that you've had for many years, so you weren't looking to develop the property? What you were looking to do was derive income, and then at some point you sold it. So again, what you're looking at is the badges of trade. You're back to them in terms of looking at what was the motivation. Was that an element of dealing or developing UK land, or was it an investment activity which came to its end, and therefore you made something which would be determined as a capital gain rather than necessarily an income gain? Other elements that you would look at, so the Revenue recently updated their guidance on the implications of the introduction of FRS 101, 102 and Section 1A of FRS 102 for corporation tax and income tax purposes. Principally, obviously, mainly for corporation tax purposes in terms of companies, but not exclusively on that basis. So the areas that will see substantial changes, and this is where one might want to do a risk analysis on your clients, would be on leases, where the definition or the barrier between operating and finance leases may well have changed, potentially looking at different times for the deductions that you can get in terms of lease costs. Secondly, looking at software costs. So, for example, there is a difference between software which is an inextricable part of hardware which makes it run, so it's operating system, and software which is put onto a system to make it run programs. Those second category of software are more easy to deduct, as potentially either you will capitalize them and get an R&D, or maybe take them as revenue expenses. So those second element, which are not inextricably linked to hardware, can be treated as software costs. If you have spent time and money developing that software, potentially R&D tax credits would be available. Thirdly, as I mentioned before, there's the ability to recognize income at different rates, potentially for an unfinished project. As somebody said, if you have